if you're talking about, fiscal support to growth, one must keep in mind that while the center has consolidated over the last 3 years, the state governments have been extremely profligate. So if I look at the combined state and center fiscal deficit, it's been running around 7% for the last 3 years. At 7% fiscal deficit, it's a significant amount of fiscal expansion already in play. So I think, in terms of, just the overall size, I'm sure that the government, if it wants to support the economy and wants to put in fiscal stimulus, that it's well within its, rights to do it. But it has to realize that there is a significant amount of fiscal expansion that is already in play for the last 3 years. And if that amount of fiscal expansion can't deliver you a higher growth rate, then I think the problem lies elsewhere, not on the lack of fiscal stimulus.
So, what kind of intervention would you then expect, Jahangir? What one is hearing at this point in time is that there will be perhaps an additional push given to infrastructure spending, infrastructure investment to try and boost growth as well as aid job creation. In the short and medium term, then, what would the expectation be in terms of intervention?
Look, we tried public spending, right? I mean, if you remember, there was this huge argument that because private spending and private investment had been falling for some time, the need of the hour was public spending. So we did public spending. That hasn't really got us anywhere. And if you think about near-term impact, I think it's very difficult to see expenditure actually boosting near-term growth, largely because any new expenditure takes a significant amount of time to be planned, to be designed. And typically, by the time you actually have planned and designed and implemented that spending, probably the time for withdrawing stimulus has come and not for putting stimulus in play. So I think the expenditure side, using the expenditure side, has a very long gestation lag. And therefore, the impact on growth on the ground from any kind of expenditure increase is going to take a very long time. And it's not a near-term, doesn't have really the kind of near-term impact that people imagine it has. So you have to rely on tax side of the budget to provide any kind of immediate stimulus.
If you're saying that the impact of any fiscal stimulus at this point in time is going to bear fruit, a few months down the line, the government is keen to aid growth in the immediate term. What then about, the space that we have on the monetary side, Jahangir, and whether we do see the possibility of another rate cut and how that will actually play out in terms of aiding growth?
Look, I mean, forget about the actual policy rate. Let's look at what the increase in the liquidity has done to actual lending rates. Lending rates have come down by 75 to 80 basis points over the last 9 months. Interest rates on the 10-year yield has come down. So none of that has actually made any discernible impact on growth. I'm not saying it hasn't made any impact on the margins, but not really anything substantive and discernible. So the problem isn't really that people aren't spending because interest rates are too high, corporates aren't doing investment because interest rates are too high, and that's the binding constraint. Corporate spending has come down for the last 3-4 years. So this is not a new phenomenon. I don't think, cutting rates 25 basis points here and there, it can be symbolic. It'll do great for asset markets, but I don't really think it does very much for the real side. If you look at when and how, fiscal stimulus has almost an immediate impact. Let's go back to 2008-9, when during the global financial crisis. At that point in time, the area that was used the most in order to provide that fiscal stimulus was cutting indirect taxes. Unfortunately, we just implemented a GST.
Yeah.
We had a massive shift in the structure of indirect taxes. I would love as an economist to see all the 5 bands to be reduced to one single band at 12 or 13%. But look, that's not going to happen. You know, it requires the GST Council to be brought into play, and that again is time-consuming. So you really don't have that much space. You can cut excise taxes on oil products, but then those cuts have to be substantive.
So, Jahangir, given where we stand today, what is now the estimate as far as growth itself is concerned? What are you working with as the assumption for Q2, for instance?
We are looking at, obviously, a slowdown taking place in Q2 growth. But again, you know, the way to look at it is that one has to go back and look at what are the drivers of India's economic growth. And for a long period of time, I think policymakers had this belief that, you know, somehow the other global trade and globalization and the global economy is going to turn around at some point in time, and India is basically going to get lifted. Now, what has happened over the last 18 months or so, the global economy has turned around. Emerging markets across the board have had significant increases in their growth rates. Unfortunately, that tide has lifted many boats, but hasn't lifted India's boat. So really, I think that the focus needs to be on, rather than trying to find out short-term solutions to the problem, is to basically go back and say, are we missing something in the India picture that has forced us into this situation? And even medium-term, you know, changes can have very powerful short-term effects if those medium-term changes are credible. And I would turn to less, you know, using the budget less, and probably focusing more on the regulatory side of doing business in India.
Well, Jahangir Aziz, appreciate you joining us with that. That's Jahangir Aziz of JP Morgan on the